Apes and apettes, welcome back to the channel. The Fed on Monday is having an extradited closed door meeting. So we're going to go over exactly what that is and what could happen, because the Fed could spice things up a little bit more. And when I say spice things up, that's a dramatic understatement. They could push us very close to the MOAS. So I want to go over that situation as well as everything else you guys need to know revolving around AMC. So if you guys get value out of this video, simply entertainment or education, hit the like button for me, subscribe to the channel, as well as comment down below. Thank you guys for watching. If you guys want access to all of my trades in real time, yes, I will likely be making more trades based off of what I'm saying here in this video. Check that link out down below in the pinned comment. So diving into it, AMC is up over 3%, sitting at $19.19 at the time of recording, and it's looking quite bullish on the day. The S&P is actually down, which is very interesting. The S&P is down 0.30% for good reasons. Futures were down a whole hell of a lot more last night, but we have since recovered just a little bit. As far as the Ortex data, and I kind of want to just dive through this so we can talk more about this Fed situation, because that's really what is going to dictate the markets if anything comes out on that Fed meeting. So the short interest of free float is at 22.08%. So very, very high. And we just got the exchange reported short interest data for January 31st, and that came in at 21.01%. So 22% is the estimate right now. And that seems very reasonable, if not under what we are likely to come in at the next exchange reported short interest day. You are looking at 113.33 million shares that are sold short, cost to borrow max of 1.9%, share utilization of 100%. And a lot of people ask, why is the utilization 100%? Just so you guys know, people that hold AMC stock that would be able to lend the shares out, like the institutions, the BlackRocks, the Vanguards of the world, they don't want to lend out their stock for a measly 2%, and that's the cost to borrow max. They don't want to lend it out for 2% if the stock is going up 10 to 15% on any given day. So that's why you've seen the utilization jump up so much. That is a very bullish sign. Days to cover is 2.51. So looking good right there. And as far as the option flow sentiment for the day, positive order value of 52%, 14 orders totaling $4.47 million. Over the past week, 54% positive order value, 160 orders worth $83.27 million. Yesterday, we were at 72% positive order value. 52 orders and $34.61 million in total. So you're seeing a lot of back and forth today. It's pretty much a neutral slate as far as options and institutions are concerned. And this is not the overall picture. This is just the large trades, the block trades, and the sweep trades. It's known as unusual option activity. It kind of gives you a sense of what institutions expect to happen in the short or midterm. So that's the key. That's all you guys need to know from the Ortex data. The 13F filings, let's go ahead and refresh this page. And we could see there's quite a bit of selling. 1, 2, 3, 4 firms have sold out, whereas other firms are loading up on their positions. Generally speaking, the firms that are selling out don't have massive positions. You're not talking about millions of shares here. You're talking about 10, 20, 30,000 shares. That's what most of these firms have that do end up selling out. So I don't think you're going to see a lot of selling pressure from the institutional investors anytime soon, but it is a mixed bag, as you guys can see right here. Some negatives, some positives, as far as institutions adding or subtracting from their overall positions. So it's pretty much neutral on that aspect as well. And as far as the max pain, we're looking at $18 by the end of today, which looks like we will be above that. Definitely a good sign. Still, right now, we're starting to pop. We're at $19.37 per share, and the activity is very, very bullish. The fact that the SPY is down and AMC is up 4.22% right now is a great thing, approaching the highs of, just hit the high of the day. So that is looking really, really good in that aspect. As far as The Stonko tracker data for next week, 35,000 calls that are in the money. 228,000 calls that are out of the money. So that could definitely lend us a lot of potential buying power if we do see a movement to the upside in AMC stock. 34,000 puts that are in the money and about 91,000 puts that are out of the money. Same thing there, decent amount of puts that are in the money that if they run out of the money could also add to the buying pressure for AMC. Now, let's talk about this Fed situation, because that is really the most important thing right now, because the Fed could make or break the markets. The markets focus on the Fed more than anything else. They don't really care about anything. And yesterday will kind of prove that to you guys. If you do look at the SPY, once CPI had come out, the markets were down a lot. They shot right back up once Fed Bullard, he's a male, he's a voting member of the Fed, started to say that normally in times of, normal market, when inflation was at 40-year highs, they would raise rates immediately. They would take more aggressive action, and that he does support raising rates to 1.25% by July, which would imply 2.5% rate hikes. That freaked out the markets. The markets started to sell down. But the overall picture here, we're still at the same levels we were a couple weeks ago. The markets have moved a lot, but they haven't went anywhere. They're still in this range and still above where we were even back here January 24th when we did have that big down day and then that big recovery. This day was historic in and of itself. So that's, really the scoop, what's going on with the SPY and how the Fed does really dictate what happens to the markets. People fear or they love the Fed, depending what cycle we're in. Now, there's a lot of rumors right now about the Fed coming out and raising rates unannounced. And they did. Check this out. It says, why is the Fed suddenly holding an unscheduled, expedited closed board meeting on Monday? With Fed speakers and their media proxies scrambling to walk back St. Louis Fed Jim Bullard's calls for an inter-meeting liftoff and uber hawkish rate hike trajectory, it is notable that all of a sudden the Fed has called for an expedited closed board meeting on Monday, February 14th at 11:30 a.m. Interesting, huh? It says, if you do take a look at this, we are sure this is probably nothing, right? But it's got us thinking about the last time the Fed held such a meeting. In late November 15th, the Fed held an expedited meeting to review and determine by the Board of Governors of the advance and discount rates to be charged by the Federal Reserve banks. Shortly therefore after this happened, the Fed hiked rates for the first time since 2006. And you could see right there, the expedited meeting, couple days later, they rose rates for the first time. And then they kept them flat for a while, and then they kept raising rates. So very interesting when you think about it like that and what history has done and the fact that inflation is at 40-year highs. It seems like they have to do this. And it could take a little bit of time after this expedited meeting. I wouldn't go balls to the walls. This is not your opportunity to get rich playing options. I don't think that is the case. I think a little bit can go a long way if you are somebody that trades options and you're willing to take on that kind of risk. I personally will have a little trade on this. Probably not going to go too crazy. And if you guys want access to those trades, link down below in the pinned comment. But overall, what would happen if the Fed came out and raised rates unannounced? Well, it's going to show a couple things. It's going to show that the Fed is admitting defeat, that they essentially have lost the war against inflation, and that they have to go faster than their already quite aggressive rate hike path. Goldman Sachs, Bank of America, they're pricing in 7.25% rate hikes in 2022 alone. That is a rate hike for every single FOMC meeting this year. If there is another one, then people are going to expect, like, hey, how many more are we going to see? Are they going to fight inflation as aggressively as, they did in the 70s or 80s? And if you guys take a look at this, this is the federal funds rate with the blue line, and the red line is inflation. Every single time inflation spikes really high, the federal funds rate has to go higher. You can see the red line is under the blue line. Ever since 2008, there has not been much of this correlation because inflation has remained low. But before that, the federal funds rate always had to be higher than inflation to get inflation to go down. And like I said, back here, since 2008, it's kind of not correlated the same way. We had the pandemic and all of that, but they were also doing that back here for inflation that was only like 3%, 2.5%, 3%. So when you think about it like that, if inflation is now way up here at, say, 7.5%, inflation's literally up here, guys, where my cursor is. So it's to keep the federal funds rate down here and hope to see what happens. I don't think that makes a lot of sense. And I think raising rates now is probably the best course of action for the economy, believe it or not, because the last thing you want is the Fed that didn't raise rates this whole time. The economy starts to slow down. Inflation is very high. So to stimulate the economy, the Fed usually will cut rates. Now, they can't cut rates if inflation is high. They can't print money if inflation is high. So if you start to see an economic slowdown, the Fed really has nothing they can do because inflation is so high. They have to kill inflation first, deal with the backlash of the economy slowing down after. That's how these rate cycles work, and that's why every time you see 3 to 5% inflation, you do see a recession. Right here in the gray, right here, right here, right here, these two right here, and this one right there, that one right there, and 2008. The only time this didn't work was the pandemic, and that was obviously a very quick recession because of the pandemic, and the Fed brought us right out of the recession. The reason the economy has been so good, arguably, right? Some people would say it has not been, but the stock market has been so good over the past year, 2 years, is because of Fed Jerome Powell and them supporting the economy. Now that that is getting ripped away, if they do raise rates on Monday, if they come out with some crazy announcement that's going to scare the markets, and you could see a very, very brutal day in the markets. So I want that to be very clear for you guys. I don't want you guys to jump and panic. It's, not something that you should panic about. But even, back here where the Fed did come out and raise rates all of a sudden, you've seen a lot of drops in this time period. 2015, 2016, not a very good time for the market. So that's basically the scoop. If I were to imagine what would happen if the Fed came out and just raise rates all of a sudden, if we're trading up here, at the 447, 448 mark on the SPY, I would expect to instantly go down to 420 or even 400 on the SPY. I think you'd see a major drawback. So that's going to be all for this video. Like I said, if you guys want access to all of my trades in real time, link down below in the pinned comment for that. Check out the links for free stocks, link for Moomoo, Webull, and Public down below in the description of this video. Go ahead, follow me over on Twitter as well, also linked in the pinned comment. Thank you guys for watching, and I will see you in the next one.